So what are we going to learn in this particular session is what things as an analyst while doing anything related to credit, what exactly we should look for, where we should look for in annual reports or anything related to companies, company official documents, and we will do that with some of the examples. Now, since credit appraisal or credit assessment is a long process and it's a lengthy process, so unfortunately, due to paucity of time, we will not be able to cover everything uh, because every company will follow separate models. So since it's a lengthy process due to paucity of time and every company follows a different structure, we will set a common ground. As in when you start with the credit appraisal or credit process, these are some of the things which everyone follows. So we are not getting into credit rating per se, but we are getting into what all things company or credit rating agencies or bank look for whenever they give out some of the loans or some of the appraisals which they do. Every company may follow different approach towards the rating, uh, depending on what kind of percentage they give to each and every ratios. But we will be able to understand max whatever we can try to cover in one particular hour of session. So with that premise, let's move on to the basic terminologies, which is there are four different types of ratings which usually company or the banks or the credit rating agencies follow. So it starts with the corporate rating, where company rates a particular corporate, a financial strength of that particular corporate, cash flow analysis, and how fast or how stable the cash flows are. That's where the maximum analysis happens whenever the company or the bank does anything related to a corporate rating. Now, corporate rating can be in two parts. One is related to manufacturing sector and one is related to services sector. Over here, my raw material cost has the maximum impact, and over here, my manpower cost has the maximum impact. And hence, most of the companies have segregated manufacturing sector versus services sector. Next comes the financial sector. Since financial sector has huge debt or huge leverage, they work with a lot of leverage to the tune of 10 to 15 times. That's why the financial sector rating is segregated from the corporate sector rating. Corporate sector primarily involves only manufacturing services sector, and then we have something else called as financial sector rating. Next comes the sovereign rating, which is for a particular country where the macroeconomics play a very important role, where the fiscal deficit or budget deficit, balance of payment, strength of currency, political risk, everything becomes a part of it. And finally, we have something called a structured finance rating. Structured finance is basically a product which has been introduced by a corporate or by an investment bank, and then we have to rate that particular product depending on what kind of asset it backs. So mortgage financing or mortgage backed securities or asset backed securities, basically something related to financial engineering, will fall into this particular category. So these are the types of ratings which the companies or the banks do. Coming to the methodology, or coming to the some of the terminologies, which is what do you mean by outlook, what do you mean by watch, and what do you mean by action. So outlook means company has done or the rating agency has done something related to some analysis, and on the basis of that they have come up with the rating. They have not changed the rating as such, they have just analyzed something depending on some of the news, which can be a stable, a positive, or a negative. It is basically a future outlook depending on the cash flows, depending on the business, depending on certain kind of risk if some of the scenarios change. Now, if the scenario is big and it is going to impact a particular company drastically, then it falls under watch category. That means the rating can change, and that's why the companies or the credit rating agencies follow this. It can be under a watch category. And finally, if after proper due diligence companies decide to change the rating, then there are three different types: either a upgrade, so basically a rating upgrade, or a rating downgrade, or stay where it is. That's basically rating reaffirmation. So these are the three different terminologies which we had, and this was just to set a ground in which direction we are going. So with that premise, let's start. Why do we need this? As in, why do we need uh, to analyze or to look at the annual reports thoroughly? Or why, as an analyst, why cannot we trust the standard ratios, or why cannot we trust the computer generated ratios as such? Or for example, from Money Control or from any other website, why cannot we trust blindly? So let's understand the example of Hindalco. So so let's go to the annual report over here. I'll quickly explain you why do we need to do that. What is the primary premise uh, as to why we have to look at some of the nuances within the annual report. So let's say most of must have understood what the interest coverage ratio means. That means what is my capacity, or what is my company's capacity to pay back my interest. That's basically EBIT upon interest cost. All right. So if we consider Hindalco, so over here my EBIT is, or if I take profit after tax, including the finance cost, or let's take profit before tax, which is around 2,000 crores, and my interest cost, which is going to be my finance cost, is going to be 435. So that means 5 times I can cover my interest through my EBIT. Obviously, I have to make some adjustment to the EBIT 5 times. However, if we look at, there's some issue with this. If we look at the total debt of Hindalco, which is long-term plus short-term borrowings, which we'll find from the annual reports or from the balance sheet, which is my long-term borrowings is to the tune of 20,000 CR, and my short-term borrowings is to the tune of 3,700 crores. So net my liabilities are to the tune of 27,000 CR. But my total interest is 435, which comes out to around 2%. Now what on earth Hindalco is safer than Government of India? A. How Hindalco is getting lesser interest rate than Government of India's yield, which is around 6-7%. This is the 2012-13 report. So at that time the yield was around 6.5%. One of the question, or one of the argument is uh, they must have taken some loan from the outside. I don't deny that argument. However, still something they would have taken from the bank. So if we dig deep, we will be able to find out how much loans they have taken. uh, for the time being, let's assume that they have taken all the loans from the India. So how come they have 2% over here? So as an analyst, if you dig deep, which is from the finance cost, which is note number 31, if you go to note number 31, you will be able to identify that their actual interest expense is to the tune of 1901 crore. And now if you divide 2000 divided by 1901 crore, this ratio will, from 5 it will drop to almost 1. And if this interest is a little higher, then the ratio will deteriorate very quickly. And now let's try to identify what is their finance cost, which is 1901 divided by 27,000 crore, which is almost 8.5%. Now this ratio seems comparable. So what actually has happened is they have capitalized interest. In some of our other videos, we have explained capitalization of interest. That's the issue. That's why as a credit analyst you need to make a lot of changes in stated annual reports or annual numbers, without which you will not be able to perform credit research to a large extent or to a thorough extent. There's another example which is Gujarat Automotive. The example is very interesting over here. They have not defaulted as such, but let's understand with the help of some of the pictures. So this is the annual report from the year 2014. So Gujarat Automotive is a small company making profit. If you can see in 2004, they have paid off all the liabilities. They are making profit, and hence the reserves are getting increased, or reserves are increasing. Couple of others interesting data points which we get from the balance sheet is that trade payables has increased substantially, and their cash and bank balance has decreased substantially. Now what has happened? So some might argue that they would have paid this 1 crore. So even if I deduct this 1 crore from the cash, ideally my cash bank balance should be around 5 crore. What has happened? So if we dig deep in the related party transaction, if we go deeper, or if we go to long-term loans and advances, which it has increased over here, long-term loans and advances, if you look at over here, it has increased from 1 crore to 11 crore. There's a substantial jump. So if we look at in the long-term loans and advances section, it says that my deposit to other than banks has increased by 9 crores, which was not present over here. Now what exactly has happened? So during that time, during that particular year, the Gujarat Automotive was taken over by Him Technoforge, and they have given loan to that particular company. Again, that's fine, but the situation now is completely different. In 3 years, their loans from nil has increased to the tune of 5 to 6 crores, and long-term loans and advances to that particular company has increased from 10 crore to 30 crore. There's a humongous difference. Reserves and surplus was 32 crores against loans and advances is now 30 crores. Initially, against my reserves of 18 crores, I had loans and advances was very minimal, which is around 1 crore, which was manageable. But over here, it is humongous, and that particular company is taking advantage of credibility of this particular company. Now, as a shareholder or as a bank, you have to be very cautious where the money is getting used. That's one particular question you need to ask in, day out, even if you're doing a credit research. And that's precise the point. Over here, you can see a lot of loans given to intercorporate deposits as a part of intercorporate deposits. So that's where. Let's start with some of the ratios with a twist. So as a part of the practice followed by some of the rating agencies, uh, this is one of the ratio which is gearing. Now everyone knows gearing as in basically how much of my debt is to my total net worth. Now usually we take total net worth. Over here there is a change wherein the rating agencies take only tangible net worth. So even if the company has lot of patents or lot of goodwill which they cannot measure. Why? Because on liquidation, it is not necessary that companies will get so much amount of money out of this. But if it's tangible, they will surely get some amount of money, or mostly whatever is the market value. And that's why to the total debt, they take tangible net worth. Now we have taken an example of two companies. Like I said, one is Tata Steel and one is Kingfisher Airlines. So every data has been fed. We have done most of the analysis like the standard ones. However, on the ratio side, These are the six different ratios which we usually don't understand or which we usually don't cover, and with this, which is with a twist, and that's what we have covered over here. So if we consider the gearing, that means how much of my debt has been sponsored by my equity, or how much is my leverage in a net scenario. But this net worth is tangible net worth. And intangibles, which is goodwill or anything patent, which is not part of it. Now, if I take an example of Kingfisher, it says that my debt is definitely higher and it is coming negative because my net worth itself is negative. So if I go to my balance sheet, over here you look at my reserves and surplus itself is negative. So even if I ignore the negative side, if the ratio is above 1, 1.5, that means that I have a higher degree of leverage. Now, financial companies or rating companies usually understand this as a red flag. Why? Because if the company is seasonal, cyclical, and if company has lot of issues related to the payments and is a high fixed cost business, then this leverage can hit at some point, because not all the time my intangible assets will help me, and not all the times will I be able to generate that much amount of money profit basically. But I have to pay my interest and my liabilities day in day out, every month, every week, as per schedule. So that's why this important becomes very critical. Now this is a defunct company. You might say that this is a post facto analysis. However, there is a twist over here. This is the first ratio. So let me open a history of Kingfisher, which I found in Wikipedia. So it says that in November 2010, Kingfisher Airlines completed restructuring of 8,000 crore. At that time also, banks gave the loans. Now we are here at 2010, which is 9 and 10, 10 and 11, 11 and 12. At that time also, the situation was not very well. They were already making losses, they had negative net worth, and they had a lot of debt. Still, banks decided to give a loan. That's a complete red flag. However, let's try and understand Tata Steel. We have taken an example of Tata Steel. Why? Because Tata Steel is again trying to acquire Bhushan Steel, which is again a defunct company, which is already filed for bankruptcy. Now let's try and understand what analysis is over here. So if we look at the gearing ratio over here, again the similar story, only difference is it's positive. Why? Because there are some positive resources over here, if we consider Tata Steel as an example. However, if we look at this, the ratios or the reserves has started declining. Why? Because they are making losses. Second, the interest payment is huge and that's why they are making losses. Now people started sharing that they will give 34,000 crores worth of Bhushan Steel, they will pay debt. So it is definitely good for Bhushan Steel. However, the question remains the same. Where will Tata Steel get 34,000 from? If the every ratio is negative and every ratio has giving a negative sign, and if still they are able to get a loan, it is just because of the Tata Skion or the brand value of Tata, they will get a loan. If that's the scenario, then investors have to be worried about it. So that's one interpretation which we can take it from this particular example, which is, just a second. From this particular ratio. Now moving on, there's another ratio which is total indebtedness ratio, which is total outside liabilities divided by tangible net worth. Now why indebtedness is important? This will become important only when there are a lot of outside liabilities. And what do you mean by outside liabilities? We have taken this example again, considering the fact that recent developments in Nirav Modi or PC Jewelers case, or Gitanjali Gems case. So wherever you have total outside liabilities higher, which is either it can be a off balance sheet item or something which is contingent or something which is non-fund based, basically LC or CC or anything of that sort. Whenever you have such high level of debt, then you have to use this total indebtedness ratio. uh, Banks usually ignore this kind of a ratio because most of us, even the PNB ignored how much potential exposure they have. If they had calculated indebtedness ratio, they wouldn't have made such a mistake. Let's see what the mistake was. As per the news, the total scam is to the tune of 12,000 crores, which is potential through one company. It is not the entire gems and jewelry segment by the PNB. So if we go to Basel 3 report by PNB, let's identify what was the exposure they had given when they disclosed as part of the framework. So as per the Basel 3, every quarter you have to release your exposure and you have to submit to the RBI. So this is the consolidated exposure. If we go to the non-fund based exposure, it says that it is to the tune of 2933 crores, the geographic distribution. And if we go to gems and jewelry, so they have given as per the industry wise as well, industry type distribution of exposure. This is fund based, which is a direct, there is a collateral which is involved. If we go towards non-fund based, which is over here, industry type distribution of expenses, non-fund based. Now understand, PNB declared that they have a total exposure potentially to the tune of 12 to 14,000 crores to one particular company and not to the entire jewelry and gems segment. However, when they disclosed in Basel 3 to the gems and jewelry segment, this is gems and jewelry segment, their total exposure which they had calculated was 842 crore only. And that's alarming, considering that now they have realized that they had lot of exposure. Had they calculated total indebtedness ratio, uh, which is which is not mentioned in the annual report of any particular company, how much LCs they have or to the what tune they have the LCs. So if you calculate indebtedness ratio, you will be able to understand this very clearly, and this is usually missed by textbooks. This is only applicable or most applicable to the segment where you have a lot of outside liabilities. Moving on, we usually do interest coverage ratio, which we have seen in the case of Hindalco. Only caveat over here is this interest and finance charges, either you have to take it from notes or from cash flow statements. You cannot take this, you cannot take this. One second. One should not take interest cost from profit and loss statement, because if you take from profit and loss statement, you will be mistaken if the interest cost has been capitalized. Otherwise the ratio remains absolutely same. There is no issues with that. But only thing is you have to take it from notes to the financial statements or from the cash flow statement, where you will find the exact interest cost, but not from P&L. That is the only difference in this interest coverage ratio. Now we have understood about debt service coverage ratio. So usual argument is debt is more important than the working capital from the bank's perspective. From the bank perspective. So basically, what does it mean? That debt has to be repaid first, or debt has to be looked at first without looking at working capital. However, from the business perspective, working capital is more important than debt because they have to run the business. Everything remains same over here. Every formula remains the same over here. However, there is a minor tweak which we call as cash debt to service coverage ratio, which is CDSCR, which most of the company or most of the credit rating companies use that. Everything remains same where we have profit after tax. We add depreciation because depreciation is not paid. However, companies or credit rating agencies think that the working capital requirement, which is, so let's say I need 100 rupees and I need 125 rupees next year. So this increment, some of the increment which they have taken is 25%. So this 25% increment or 25% of total increment has to be borne by the internal accruals. For that, bank will not be able to pay any amount of money, and that is the difference. So if we go back to the Kingfisher Airlines example, my DSCR was obviously negative because I was not able to pay my debt because my debt was huge. But if I go to my Tata Steel example, which is over here, it says that I'll be able to service only 55% of my debt plus interest through my EBITDA within a year, and which has been decreasing. Now consider this example or consider this scenario. The company is growing, there is no doubt about that. Company is growing because of the demand or whatever may be the reason. If I have to fund this 25% of my working capital or incremental working capital from my EBITDA, so my numerator will decline and hence this ratio will also decline. And that's a potential red flag saying that the company may go into a default territory. Again, a red flag for Tata Steel, or again, a red flag for the lenders, those who have given or those who are planning to give loans to CD to this particular company, because same thing has already happened with Kingfisher over here. It is a similar trajectory which this company is following as of now, in our opinion. Now, moving on to one last, which is very different ratio, is uh, related to the cash flow per se, which is net cash. So this is net cash accruals to total debt. This means how much year I will take. Net cash means how much year I will take to pay my entire debt, including all kinds of debt, short term, long term, on off balance sheet, everything. So which is net cash means how much PAT I have minus dividend plus the depreciation, because this is a non-cash expense, divided my total debt. So if this is high or lesser, the better. This is one of the ratio which we never study, which is not part of books, but it is more like an evolved ratio. Alternatively, if we reverse this, basically total debt upon net cash, then it basically says that net cash accrual, then this basically says that how many years will I take to reduce this to zero using only my net cash, higher the worse. So if there is a company which takes 5 years through net accruals to pay entire debt versus there is a company which takes 10 years, then this is a potential issue for this another company. Let's understand that in the case of Kingfisher Airlines, which was obviously negative, but let's understand in the case of Tata Steel. So I just have to reverse this. So equal to 1 divided by this much, which is I will take 15 years or almost 16 years using my accruals to pay my debt. If I do this over here, the years has increased. So let's understand that my net accrual is to the tune of around 1000 crores, and my debt, which is on the balance sheet, is to the tune of 15 or 65,000 CR. Over here, I have taken added back the depreciation. So that's why the number is 20. I have added back the depreciation in PAT. So whenever you are taking this PAT, don't make that particular mistake, which is over here plus whatever my depreciation is, which is over here net 6,000. If my total debt is around 18-90,000 crores, then I will take around 20 years. So my net accrual at this particular moment is around 6,000 crores, and I will take 20 years. So my total debt is 1.2 lakh crores. Do we have that much debt? Technically, yes. So this loans is around 65,000 crore. Other liabilities are the tune of 15,000 crores, and all my short-term borrowings is to the tune of 15,000 crores. Net 1 lakh crore debt I have. This is humongous. In addition to that, add another 35-40,000 crores which they are planning to pay to the Bhushan Steel. Now think from that perspective, is it good, bad, or ugly? So these are the kind of ratios which are very different, Now, couple of other pointers before we close this is we always have to look at, so this particular point, which is cumulative PAT and cumulative CFO, is very similar to net cash accruals. What does it mean is, so let's say I am generating PAT 100, 150, 150 in 4 years, which is 500 crores, versus cash flow from operations I'm generating only 20, 20, 15, 15, which is 70. Now understand one particular thing. My PAT is high, but my cash flow from operation, I'm not able to generate cash from my operations, which is far less than what the cash I'm generating through PAT. There can be two issues. First, I am or company is aggressively booking sales, like in the case of real estate, and not realizing money as such, or not able to get money from parties. Parties is basically the customers, and that's pitfall number one. Why? Because you will be running this business every year, irrespective of whatever the money you are generating here. Now, to run this business, you need this extra money because you are not generating cash from here. If you are not generating cash from here, then you will generate cash flow from financing activity, and that's one of the another red flag. If my cash flow from financing activity is positive, continuous, day in day out, then there can be a potential red flag, because I'm taking money from the parties and I'm funding my business, and my cash flow from operation has to be negative. Let's look at that in Tata Steel example versus something which is more stable in the Tata group, which is TCS. So if I see the cash flows in in uh, Tata Steel example, look at this. So they are generating some cash over here. They are investing, so that's fine, and they are taking a lot of money from the financing activity, or they tend to take. Versus if I do something related to TCS, which is over here, which the data which I've taken from the screener, look at this. They consistent higher cash flows, they're investing a lot, and they're paying a lot of dividends, versus Tata Steel. Look at the amount to the money they generate. Also, look at the Tata Steel from this particular other company, which is Tata Motors. So look at the net profit over here. Last 10 years, they have generated a total profit of 81,000 crores, versus something over cash flow from operations activity, which is over here, they have generated 2.06 lakhs. That means they have generated a lot of cash, but they are not able to convert into a profit because of capex A and total debt B. Completely opposite examples within same group. So one group is pretty constant, where cash flow from financing activity is positive, and cash flow from operating is positive, high positive, and cash flow from financing is high negative. That means they are giving a lot of cash. Another company in the same group, which is Tata Steel, they are able to generate reasonably cash flow from operations, but they are not able to generate a lot of cash flow from financing. That means they are taking a lot of money inside also, and they are giving out away a little. And third company, which is Tata Motors, so their cash flow from operations is very high, and PAT, cumulative PAT, is less. That means over a period of time they have not been able to generate a lot of profit. Why? Because they have taken a lot of debt and they have to pay a lot of interest, and that's why the money generated, cash flow from operation, goes into repayment. So that is basically a good sign. In the longer run, whenever the entire debt is paid off, this will give me a lot of money in terms of PAT. But if this is hugely positive, if my cash flow from operations is negative, and if my cash flow from financing is positive, then that's a complete red flag. Do we find an example like that? Let's try and understand. Let's see what Unitech does. So if we go towards the Unitech, if we try and identify, look at this. Their cash flow from operating is turned negative, and cash flow from financing is whatever the amount it is over here as of now. Uh, Companies do make mistakes in this particular thing. And while analyst, you have to try and identify what exactly this particular thing is before you reach to any particular conclusion. At the same time, you have to understand this. So far, we have not found this particular example in a bigger company. There are a lot of smaller companies where receivable days have increased. That means companies not able to recover money, and at the same time, inventory turnover has decreased. That means sales have dropped big time. Both this spiraling, because if my sales has decreased and I'm not able to generate my or not able to free my working capital which I have previously given, then there is a potential issue. How will I run my business? How, where is the money? And then you have to rely on cash flow from financing activity, basically loans, debts, and that's a potential pitfall. You have to see both this thing in tandem, and not any one particular ratio, but you have to see both this thing in a tandem.